Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, December 17th. The mood in Europe feels anything but festive this pre-Christmas season as French and German politicians bear the heavy weight of gloomy economic conditions here in Europe. But across the Atlantic Ocean, it's a fully different story. Markets in the US are riding high with Donald Trump and the Federal Reserve giving investors all the support and all the money in the world to keep the party going. Europe appears to be coming apart one nation at a time, writes Bloomberg, to summarize the complicated politics of the old continent. It appears that it is coming apart one nation at a time. It's rough, but it is true because after the French snap election that led to a divided French government and an ungovernable France since summer, German politicians gave a no-confidence verdict for the three-way ruling party of Germany, paving the way for an early election in February in Germany, so that's about 7 months earlier than scheduled. It means that, well, the Germans will be joining their French neighbors in a political gridlock and political uncertainty. Chic, right? Now, obviously, the energy crisis and the weak global demand explain the most of the German economic misery of today. The German economy could have grown 5% more over the past 5 years if it could maintain the pre-pandemic and pre-Ukrainian war trend. But funny enough, it did not, and even funnier enough, looking at the DAX index, you wouldn't guess that the country is experiencing harsh economic meltdown and political shenanigans because the DAX index in Germany retreated yesterday, yes, but from a near all-time high level. The political shenanigans in Germany didn't prevent the index from rallying above the 20,000 mark. This month, its technology heavyweights like SAP and Siemens followed their American peers to the north and somehow hit the misery of the car makers and others there. But the same cannot be said for France. Unfortunately, the French luxury companies could barely provide an umbrella for the rainy French days as their Chinese consumers failed to show up at the rendezvous. As a result, the SOX 600 index appears to be peaking ahead of what's shaping up to be a chaotic Christmas in Europe, while the US continues to revel in the joys of life because there in the US, the atmosphere is completely different and much more festive. Santa is coming early this year, disguised in Jerome Powell to announce an additional 25 base point cut that the country, the US economy, doesn't necessarily need on top of a 75 base point cut delivered since September in the country, and that despite the slowing progress on the US inflation. I particularly enjoyed an ex-post from Charlie Bilello the other day summarizing the US economy in a few bullet points, saying that the stocks are at all-time high levels, home prices in the US are at all-time high levels, Bitcoin is at an all-time high level. The US national debt is at all-time high level. The US CPI has been above 3% for the 43 straight months, but the Fed is cutting the interest rates again, and I think there is nothing else to add to that post. Thank you, Fed. So the S&P 500 was up yesterday, not to a record high, but near a record high. Nasdaq 100, however, advanced to a fresh record high, with Broadcom gaining another 11% at yesterday's trading session, on top of the 24% added on Friday post-earnings on their juicy forecast for custom AI chips. Nvidia, however, retreated another 1.68% yesterday and has officially stepped into the correction territory after losing more than 10% since its November peak. Now, I have been insulted for saying this, but the big technology buddies' willingness to build their own homemade chips these days is probably raising some questions among Nvidia investors, as the company made half of its revenue from the big technology customers last quarter, remember. Elsewhere, Bitcoin is exploring the moon and bounce on Donald Trump optimism, and also as MicroStrategy which is a company that made its fortune by buying massive amounts of Bitcoin over the past few years, is about to make its way to the Nasdaq 100 in December 23rd. So last week, the company sold around 1.5 billion US dollar worth of shares to buy that amount of Bitcoin. So it is as if Bitcoin itself was joining the Nasdaq 100 by the end of this December. So anyway, it's all very much great, obviously, but obviously, and of course, there are rising worries among investors about the possibility that we might be seeing a bubble in the US stock market, especially in the technology front, because the S&P 500 hasn't deviated from its long-term trend this wildly since the dot-com bubble. But a bubble is not a bubble until it bursts. So for now, Trump and Powell are giving investors all the reasons in the world to stick with their bullish positions and keep this rally going. So this brings me to the Federal Reserve, which starts its two-day monetary policy meeting today. The American policymakers are obviously expected to deliver another 25 basis point cut tomorrow and also reveal their latest dot plot projection. So it will be quite interesting to see how the T factor, so Trump factor, has or has not changed their expectations. I believe that the Trump question is, well, too politically sensitive to appear in the dot plot, but the Fed members could be smarter than that and could give the excuse of resilient US growth, less alarming developments in the US jobs market, and maybe also slowing progress on the inflation front to readjust their rate expectation to a higher place for next year, because otherwise inflation in the US will probably spiral out of control. So yes, the December cut is happening. Yes, we know that with around 95% chance assessed to it, but many out there start increasing their bets for a pause in January. Some even start talking about a potential rate hike sometime in 2025. We will see, but what's interesting is that the big banks' dollar expectations are rather soft for next year. Societe Generale, for example, sees the US dollar weaken 7% against the euro next year, pointing at the ballooning US budget deficit. Let's see. I'm not really in line with that expectation, because the reality is that we've been hearing about this US budget deficit for years. And yet, in the FX markets broadly, the US dollar index is now consolidating a bit lower than the November peak levels into the Federal Reserve decision that's due tomorrow. The euro dollar is waiting for a fresh direction around the 105 psychological mark. Now, released yesterday, the Eurozone December PMI numbers showed, well, obviously further weakness in German and French manufacturing sectors, while activity in the Eurozone services looked slightly better, even in the expansion zone, certainly due to some Christmas magic. But all in all, if the Fed sounds reasonably less dovish this week about its monetary policy, the euro dollar could extend its losses below the 105 mark. Elsewhere, the dollar yen advanced to 154.50 level yesterday on rising bets that the Bank of Japan will sit still and intervene with intervention threats. Only swaps give around 20% chance for a rate hike this week in Japan, while in the UK, traders will be focusing on jobs and inflation figures before Thursday's Bank of England decision. BOE is not expected to change its policy this week. Finally, in the commodities space, US crude kicked off the week on a bearish note, hit by this disappointing news and data from China, and could well return below its 50-day moving average near the $70.15 per barrel level on rising global glut concerns, while cocoa futures advanced to a fresh record high recently on renewed concerns about the unideal weather conditions in West Africa. And, well, unfortunately for them, the chocolate companies are feeling the heat of these rising cocoa prices. Hershey, for example, warned that the price hikes drive the volumes down, unfortunately, and that organic sales there fell 1% in constant currency last quarter. So we know what to do. We just need to eat more chocolate. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.